ASML just reported a strong first quarter for 2026, and overall, I think this was the kind of quarter that makes me feel better about the business, even if it doesn't automatically make me excited about the stock at this price. When I look at ASML, I think the starting point is always the same. This is one of the most important companies in the semiconductor industry. It's basically the critical picks and shovels supplier for advanced chip manufacturing. ASML provides the lithography systems, software, and services that chip makers need to print smaller and more advanced transistor patterns. And when it comes to EUV, or extreme ultraviolet lithography, ASML is essentially the only company that can do this at scale. So for investors, the main question is usually not whether ASML is a great business. It clearly is. The real question is how much of that greatness and how much of the future AI-driven demand story is already reflected in the stock price. And after this quarter, my view is that the long-term thesis still looks very strong, and maybe even a little bit better than it did before. But at the same time, the valuation still looks demanding. So to me, this continues to look more like an excellent company at a rich price rather than an obvious bargain. Looking at the actual quarter, ASML reported revenue of 8.8 billion euros, gross margin of 53%, operating margin of 36%, and net income of 2.76 billion euros. Those are very strong numbers. On top of that, management raised full-year 2026 guidance. The new revenue range is now 36 to 40 billion euros, up from the prior range of 34 to 39 billion. Gross margin guidance for the full year is now 51 to 53%. That guidance raise is probably the single biggest takeaway from the quarter. It tells us that customer demand is stronger than previously expected, and management specifically linked that to AI-related chip demand and customer capacity expansion. Now, let's walk through the quarter in a bit more detail.
Total net sales came in at 8.767 billion euros, up from 7.742 billion euros in the same quarter last year. That is about 13.2% year-over-year growth. For a company already operating at this scale, that is a healthy result. And I think it supports the view that spending at the leading edge is still being pulled forward by AI infrastructure demand. Within that, net system sales were 6.3 billion euros, while installed base management sales were 2.5 billion euros. I think that second number matters a lot. Installed base management is basically the service, upgrade, and support side of the business. That tends to be steadier and, in many ways, higher quality revenue than pure new system shipments. It shows that ASML is not just shipping new tools, it is also continuing to monetize the growing installed base through upgrades, field options, and services. Net income came in at 2.757 billion euros, up from 2.355 billion euros a year ago. That is about 17.1% growth. So profit grew faster than revenue, which is exactly what you want to see in a business like this. It suggests operating leverage, pricing power, and a favorable mix. Basic earnings per share was 7.15 euros versus 6 euros a year ago. That is about 19.9% growth. Again, EPS growing faster than revenue is a good sign. It tells me the underlying business is scaling well, and it also gets some help from a lower share count over time because ASML continues to buy back stock. On margins, gross margin was 53%. That is down a bit from 54% a year ago, but up from 52.2% in the prior quarter. So year over year, gross margin slipped slightly, but sequentially it improved. I would not overreact to the year-over-year decline because ASML's gross margin can move around depending on product mix, upgrade activity, and where newer systems are on the cost curve. At 53%, this is still an outstanding gross margin.
Operating margin came in at 36%, up from 35.4% in the first quarter of last year. That is an extremely high level for a company in semiconductor equipment. It really highlights how powerful this business model is. The main weak-looking area in the quarter was cash flow. Operating cash flow was negative 2.186 billion euros, and free cash flow was negative 2.606 billion euros. On the surface, those numbers do not look good. But with ASML, quarter-to-quarter cash flow can swing a lot because of working capital timing, milestone payments, receivables, and shipment timing. So I do not think one quarter of weak cash flow changes the thesis by itself, especially when the broader context is that 2025 operating cash flow was 12.66 billion euros, and the fourth quarter of 2025 was exceptionally strong on cash generation. CapEx in the quarter was 422 million euros. That is very manageable relative to revenue and profit. It reinforces the point that ASML is capital intensive, but not in a way that destroys returns. On the balance sheet, liquidity still looks strong. Cash, cash equivalents, and short-term investments ended the quarter at 8.376 billion euros, down from 13.322 billion euros at the end of Q4. Some of that decline reflects the cash flow timing I just mentioned, and some of it reflects ongoing shareholder returns. But even after that, the balance sheet remains very solid. Overall assets were 48.1 billion euros. Current liabilities were 20.3 billion euros, non-current liabilities were 6.9 billion euros, and shareholders' equity was 20.8 billion euros. ASML also had about 2.7 billion euros of long-term debt, so the company remains in a net cash position. That's a major positive, especially in a cyclical industry, because it gives ASML the flexibility to keep investing in research and development while also returning capital to shareholders.
And this is very much not a dilution story. In fact, it is the opposite. Weighted average basic shares were 389 million in 2025, down from 393 million in 2024, and the company bought back about 1.1 billion euros of stock in Q1 alone. So over time, per-share growth can exceed the growth of the business itself. Another interesting point from the quarter is that ASML sold 79 lithography systems, compared with 77 in the same quarter last year. But with ASML, unit count is not the most important thing. Mix matters much more than raw volume, because an EUV tool is vastly more valuable than an older DUV system. And in this quarter, EUV represented the largest share of system sales value. Also, memory was 51% of end-use mix, which tells us that AI-related memory spending remains very important. Now, beyond the reported numbers, I think there were a few big business developments worth paying attention to. First, again, the guidance raise was huge. Management lifted full-year revenue guidance and tied that directly to stronger demand from customers building capacity for AI-driven chip demand. On top of that, ASML expects to ship 60 low-NA EUV tools in 2026, which is roughly 25% above 2025, and it sees capacity for 80 in 2027. That tells me demand is strong, but just as importantly, ASML is working to convert that demand into actual shipments and revenue. Second, product and roadmap execution still looks solid. ASML highlighted the NXE3800 PP1.E release, which improves throughput from 220 to 230 wafers per hour at similar overlay performance. That might sound like a small improvement, but in chip manufacturing, those incremental throughput gains matter a lot because they improve the economics for customers. It makes ASML's tools even more valuable. And third, the EUV roadmap still extends well into the next decade, including higher productivity platforms. I think that matters because it supports the durability of ASML's moat. This is not just a company benefiting from one hot cycle. It is a company with a roadmap that still looks strategically critical years from now.
The bigger picture here is that ASML remains one of the highest quality industrial technology businesses in the world. The business model is exceptional. It combines near-monopoly economics in EUV, entrenched customer relationships, high switching costs, recurring service and upgrade revenue, and extremely high technological barriers to entry. So yes, this is still a cyclical equipment business in some ways, but it is not a normal cyclical equipment company. Its position is much closer to infrastructure. If the most advanced chip makers want to stay on the leading edge, they need ASML. That said, the business is not completely frictionless. ASML can scale, but it does so with long lead times, supplier coordination, and capacity expansion. The company is working closely with key partners to raise output, and that is a real operational constraint. But at the same time, that complexity is also part of what makes the business so hard to replicate. Profitability remains outstanding, and over time there may still be room for margin expansion if the mix shifts towards more mature EUV systems, more service revenue, and more software and upgrades. Management still sees a 2030 gross margin opportunity of 56 to 60% under its scenarios. So operationally, I come away from this quarter feeling very good about the business. The harder question is valuation. At a recent share price of around €1,244 in Amsterdam, ASML is expensive on traditional metrics. Based on 2025 EPS of €24.73, the stock trades at about 50 times trailing earnings. Using the midpoint of 2026 guidance and a rough modelled EPS around €30, forward PE is about 41 times. That is rich. Using an estimated share count of around 385.6 million, the market cap is roughly €480 billion. Against the midpoint of 2026 sales guidance, that is about 12.6 times sales. Even adjusting a bit for the company's net cash position, this is still a premium valuation.
Now, to be fair, ASML deserves a premium. This is a unique franchise. Plain PE doesn't fully capture the quality of the moat, the long runway from EUV and high-NA EUV, and the long-duration growth opportunities from increasing lithography intensity. But even after giving credit for that, I think the current valuation already assumes a lot of good things. It assumes AI demand stays strong for years, leading-edge customers keep spending, export controls remain manageable, ASML executes on its roadmap, and margins gradually improve over time. Are those assumptions crazy? No. In fact, I think they are mostly reasonable. The problem is just that when a stock is priced for a lot of things to go right, there's less room for disappointment. So when I think about the next 5 years, I still see a compelling long-term business. In a base case, I think ASML could potentially reach around €56 billion in revenue by 2031, with gross margin around 57% and net margin around 31 to 32%. If that happens, net income could be around €17.5 to 18 billion, or roughly €46 in EPS. If the market gives that a 32 times PE multiple, that would imply a 5-year share price around €1,480. That is about €236 above the current price, or around 19% upside over 5 years. In the bull case, if AI infrastructure demand stays very strong, high-NA adoption goes well, export restrictions stay manageable, and revenue reaches around €65 billion with net margin around 34%, EPS could get to roughly €59. Put a 38 times PE on that, and you get a 5-year share price around €2,240, which would be about 80% upside.
In the bear case, if AI spending cools after the current build-out, China restrictions get worse, and customer capex becomes more cyclical than expected, revenue might only reach around €44 billion by 2031, with net margin around 26% and EPS around €29. At a 24 times multiple, that points to a share price around €700, which would be about 44% downside. So to me, that is the key point. ASML is absolutely a high-quality company, but it is not a no-risk entry point. The downside can still be meaningful because the stock starts from a premium multiple. As for risks, the biggest one is clearly export controls. That is the major non-operational risk here. If restrictions on China tighten further, that could pressure revenue mix and push results towards the low end of guidance. Beyond that, there is also the risk that AI capex normalizes more quickly than expected, supply chain issues delay shipments, customer concentration creates volatility, or the stock simply sees multiple compression, even if the business keeps performing well. Going into next quarter, the main things I will be watching are Q2 revenue and gross margin relative to guidance, any change to full-year guidance, updates on China exposure and export controls, low-NA EUV shipment cadence, service and installed base growth, and whether cash conversion improves after the weak first quarter. So overall, my takeaway is pretty straightforward. This was a strong quarter for ASML. Revenue was solid, profit was strong, margins held up well, AI demand signals improved, and guidance was raised. The long-term thesis is still very attractive, and I would even say it improved modestly after this quarter. But from an investment perspective, I still think the stock looks more fairly valued to mildly overvalued than obviously cheap. So yes, I think ASML remains a very compelling 5-year story, but more as a high-quality compounder than as a deep value setup. For me, the business is world-class. The valuation is just less forgiving than the business quality.
That's how I see it. But let me know what you think. Do you see ASML as still worth buying at this level? Or do you think the stock needs a better entry point? And if you enjoyed this video, feel free to like, subscribe, and share your thoughts in the comments.